Bill, I'm about to ruin it for you. Sorry. No, not really. Yeah, I am. So, there is an elephant in the room. We all know it's there. We talk about it a little bit, but we're not doing anything about it. It's debt. We all love to borrow. Every single person, every single country around the world, every single company loves to borrow. And it's a problem. So back in 2019, it seemed like, it was getting a little bit ahead of itself, but we pretty much emerged from the global financial crisis, not unscathed, but we seem to be borrowing more and more every year. The whole world. Still, it kind of seemed manageable if we could just spend a little bit less. Maybe borrow a little bit less. We could rein it in a bit. Ramp up productivity, we have great technology. Maybe that would help. But what did we do instead? We shut down the world. We shut down productivity. We flooded the market with more bonds and more borrowing. Debt skyrocketed, and it is up 50% in just the last 8 years. And so we've entered what we call an exponential growth phase, where debt compounds on itself. I'll show you how in a moment, but the problem here is in the next debt crisis, we could see a 50% rise in just a couple of years. And this is where we are. These are the best countries, the G7, and every single country is borrowing more than it makes. 100% debt to GDP. That is the borrowing over the productivity of the country. So $100 trillion of debt has been accumulated, 40% increase since just 2019. And this right here is why we need Bitcoin. There is no other escape. But let's take a peek at the US. That's where I'm from. And it's the global reserve currency, global reserve asset. It's the strongest country out there as far as debt to GDP from the world's view. Like, we've got the global reserve asset. We're doing great. Look at our productivity. Solid growth. That's what matters, right? That's what we need, is strong growth of productivity. And this is what we can borrow from. Here's the problem. In 2013, we surpassed our productivity with our debt. And we haven't looked back since. The US currently borrows $1.33 for every dollar that we create productivity. And if we look at all the debt in the nation, it's even worse. This includes all households, businesses, and government. And the blue line is what primarily pays for that debt. Can you see the problem? So if the United States was a company on the New York Stock Exchange, I know it's not, but let's just pretend so you can visualize this. The issue is we spend so much money that we simply cannot make the interest payments on that debt. So what do I mean by that? Well, entitlement spending is like Social Security, Medicare, Medicaid. These are programs that are signed into legislation, right? So they are mandatory expenses. We cannot miss these payments. And then when you add the interest on the debt and you then compare it to the revenue that we make, we spend too much. So here's some simple math for you. This is from the Congressional Budget Office. These are their numbers, they're not mine. This is actually what's going on. The tax revenues for this year are expected to be $4.9 trillion. When you add in those entitlements, those mandatory expenses, that's $3.8 trillion. plus the $850 billion of defense spending, $870 billion of net interest payments, okay? So we're spending over $1 trillion every year on interest. We're getting a little bit of that back because, you know, we have intergovernment agencies that are sending some interest payments back to us, but you don't have to be a math genius to see that this just doesn't work. And the issue is, it's just getting worse. So this is the budget. This is where the Congressional Budget Office comes up with a budget that the legislators they passed their laws. This is how much they're going to spend. We all know they're lying. They're going to spend more. They do it every year. And this is optimistic. So what we're seeing here is that we're spending over 1.5 trillion. This number is actually $2 trillion a year more than we make. Now, when I say when we make, that's productivity. There's the taxes on the productivity. That's our earnings. The United States government doesn't make anything. They just take things, right? So they just take it from us. And so they're not covering the interest payments. They're not covering all the expenses. It's not even close. And the thing is, over the next 10 years, we're going to borrow more than $20 trillion. We're going to spend more than we make. Here's the best part about this. These numbers assume there's no recession. That it's a stable environment. There's no black swans. That interest rates remain stable. This is super optimistic. It's an absolute joke. Because this is the balance sheet of the United States. So if you all think that we are strong, you're wrong. If we add up all the unfunded liabilities, so everybody talks about the debt, how much debt we have is $34 trillion. Oh my God, it's another $1 trillion this week. We actually owe $247 trillion. So when you add up all the expenses that we have to make. So my business partner, David Foley, I don't see him here, he mentioned to me this morning that the average baby boomer, okay, the oldest generation in our country, the second oldest generation in our country, the average baby boomer is 71 years old. So what does that mean? That means that these expenses, the ones in the bright red at the top, they are due. It's like somebody took a grenade, pulled the pin, and threw it in the room. It's happening. There's nothing we can do. So what do we do to pay these expenses? We need to borrow. We need to borrow more and more and more and more and more and more and more. And the Congressional Budget Office knows this. This is their chart. They're showing how those expenses are the top line, that purple, those purple lines are those are the mandatory expenses that we must make. That's a primary deficit. The blue down below, that's the interest payments on that debt. So when I said that we're in the exponential growth phase, where debt compounds on debt, it's because the interest payments are getting bigger and bigger and bigger. And remember, you can see in 2006 what happened to those deficits. And then again in 2020, look, they've got it all the way up to 2051 with no recessions, no unexpected happening. And look at how bad it gets. And they know that this is what's happening to the debt. It's going vertical. It's parabolic. The Treasury knows it too. So remember, the Treasury just does Congress's bidding. They don't make the decisions on how much to spend. They just enable it. How do they do that? They borrow. They go out into the market and they issue bonds, and we stupidly buy them. So in their report, and they periodically put this out every single year, in their report last year, they subtitled the report An Unsustainable Fiscal Path. They put this out. This was online for the whole world to see. This is a report that the Treasury made for Congress. They're basically telling them, hey, listen, you've got to stop. We can't keep doing this. Why? This is a chart that was in that report. I think Lynn Alden found it first. I don't know if she's here, but they've since removed it. But we have the receipts. They put this out there for the whole world to see. They actually admitted it. I think Congress got mad, so they took it down. But why is this such a problem? Well, as you were saying, debt compounds on top of debt. Here are the interest payments we're making on the debt. That's $1 trillion every single year. It's hard to get your head around this, I know, because the numbers are so big. It's actually almost laughable if it was funny, but it's not. Here's what keeps them up at night. This is what keeps the Treasury up at night right here. Right there. 50% of our debt is coming due in the next 3 years. Y'all having fun yet? The problem is the interest payments on this debt, okay, the yield on this debt is about 2.3%. But every single bond that matures, right? So if you're the Treasury, you issue a bond, that bond eventually matures. Well, how do you pay for that? Well, taxes? No, we don't have money in taxes. You saw that. So what do? You have to borrow more. You have to put out another bond to pay the principal on that original bond. And when you do that, now that we've got interest rates at 4 or 5%, you're paying double the interest rate. So if you go back, that's why that is happening. So as debt matures, we must issue more debt. There's no way around it. Remember, we're in a deficit. The problem is that we've had a few auctions recently. I don't know if you all probably don't watch auctions. It's okay. It's boring. It's, unless you follow my Twitter feed, I make it a little bit more fun. But in November, we had a 30-year Treasury auction that was super ugly. What does it mean? It means that it was unexpectedly weak. It was so poor that the Treasury kind of scrambled to make sure that everybody knew that they were going to borrow as much as people thought they were in the future. Well, then we had a 20-year Treasury auction this month that was equally as ugly. It was the worst tail in an auction in the history of the 20-year Treasury. What does that mean? It means that when bonds, they trade beforehand in a when-issued market, it's like a pre-market, they traded at a price that was nowhere near what the actual auction went to. And it's got the Treasury nervous. Why? You might recognize this. You're from the region. This is an article that was put in the New York Times in 2011. It was about Greece. Does it look familiar? So, what happens when a country enters what we call a debt spiral? Well, deficits, as we've already told you, we have deficits. They require debt, which leads to higher interest cost. We showed you that chart of the interest cost, right? Which leads to larger deficits, which leads to more debt, which leads to eventually higher interest rates. Why? Because you will demand higher interest rates because of the risk that either the debt provider defaults, which we won't do, but what we'll rather do is we'll allow high inflation. So you want to be paid for that, which creates even larger deficits, which creates even more debt, and the cycle repeats. And we enter what's called a debt spiral. And we're in it. The whole world is in it. The United States is in it too. Make no mistake. So what are the solutions? We can have austerity. You can cut spending, right? Nobody's going to do that though. What government, what politician is going to cut spending? They won't get reelected. They can't do that. They try to trick each other into doing it, but they don't do it. Milei does, that's right. We've got one. So you could raise taxes, but raising taxes disincentivizes productivity, right? It disincentivizes companies from investing in more R&D and expanding on profitable lines. So you end up in the same spot. Productivity falls, higher taxes on that lower productivity. It doesn't work. We've seen it doesn't work. Or you could just issue more debt, which is what we've been doing. You just issue more debt, compound the debt, and hope, pray that it works out by the time that you're not reelected, you're going to retire. But of course, we don't retire, we just die in office. So no country that issues its own debt in its own currency would ever default, though. What do? They just print money. What does printing money do? It causes inflation, as we have all experienced. I mean, are you fucking kidding me with all this inflation? It's ridiculous. We all feel it, we know it. If you took an equivalent euro, I know it wasn't around earlier than the 90s, I was on Wall Street when it was created, but if you took an equivalent euro in the European region from 1960, it would be worth just 6 euro now. 100 euros would be worth just 6. And that's on the inflation rate that they admit to you. But it's worse. We all know it's worse. If you had $1 in 1960, it's now worth just 6 cents, and that's on the CPI, the inflation rate that they tell us. We know it's a lie. What's the inflation rate? The inflation rate is closer to the expansion of the money supply. So if you actually use the 7% plus running number of every year, this dollar would be worth a fraction of a penny. So, make no mistake, they must keep printing. They have no choice. They have to. And they must debate the fiat currencies. Why do they do this? I'll make it very simple for you. You saw the debt. You saw how much debt is out there. Well, how are they going to pay that off? They're never going to pay that off. How do they keep it going? They keep it going by raising productivity. How do they raise productivity? Not with AI. They fake it. They flood the market with more money. So it creates productivity, which is fake. It's just a higher GDP number. It's more dollars out there, more euros out there, right? And then they then make you pay taxes on those higher earnings, and so the taxes go up. But this is what we call in nominal terms. This is not real. I love that, because real GDP is a lot lower than the nominal GDP. You have to add inflation to get real GDP. So they don't have a choice. None of us have a choice, except the ones in this arena and some of your friends who have come to understand what Bitcoin is. Because now we have a choice. We can opt out of this madness. Here's what the global currencies have done against the US dollar. You can't read this, I'll read some of them for you. The Venezuelan bolivar is down 99.9%. The Syrian pound down 99.1%. The Argentinian peso down 98.3%. This is against the dollar. You saw how bad the dollar was, right? But look at Bitcoin in the corner. It's up 21,000%, and this is before this week. Right? I won't go into this. You know what Bitcoin is. It's decentralized, it's immutable, scarce, all of that. It's the most pure, it's the absolute purest store of value that's ever been created. And now, this is what you wanted me to talk about, right? You thought we were going to talk about institutional investing, not debt. Well, it matters, because now the institutions, they cannot ignore it anymore. They were ignoring it for a long time. Why? Because it's difficult for institutions to own Bitcoin. I have had this conversation so many times in my life with people who were not in investing like I have been. I've been in institutional investing for 30 years. And when I talk about red tape, my God, if you are an institutional investor and you want to own Bitcoin, these are kind of the steps you have to go through. Let's pretend that you are an analyst and you found Bitcoin. You're a young, hip guy, you got a hoodie, and you found Bitcoin. You're like, I think we should own some of this. I think we should own some Bitcoin. And you convince your portfolio manager that you should own Bitcoin. And believe me, that's a tall hurdle. But if you convince them that you should, then he finally gets to the point. He does some research. He's like, okay, we'll own some. But he's got to go to the investment committee, right? So he's got to convince the investment manager, the chief investment officer, and then they got to sit in front of the committee. Then they've got to be convinced. And then you've got to sit in front of, oh God, the panel of compliance. So they've got to get comfortable with it. What is this Bitcoin thing? It's been used to buy drugs. It's not real money, it's fake. You shouldn't be buying this. If you can somehow convince your chief compliance officer that you should be buying Bitcoin, God help, what, wow. I mean, well done, bravo. So, but you have problems. Where are you going to trade it, right? How is it going to get settled? Who's going to settle it? Who's going to custody it? Are you going to have your own keys? What investment manager from one of these huge pension funds that wants to hold their own keys to $1 billion of Bitcoin? Does that sound like career risk? It does to me. And they're not getting paid for that. They're getting paid to own bonds. We'll get into that in a second. But you have to go through all of these layers. So for the first time in history, you all have been able to front run the institutions. I remember back in early... Back in the late 90s, 2000, we used to have these hot IPOs, right? Amazon and Netflix and all these super hot IPOs. And as an institutional investor, we would front run everybody. And it was legal. We would just get an allocation of 1,000 shares. And our allocation would be at the IPO price, which was, let's say it's $20 for a stock. What happened when that stock got listed that day of IPO? Well, it ran not from 20 to 30, but to 50, 80, 100, $180,000. Who was buying it? You all were. Or me now. So who got the benefit? Well, they were selling to you. They got it at 20 bucks and they were selling to you at 180. Well, this is our time. So we've been buying Bitcoin for years, and they're just now getting in. The ETFs have changed the world for Bitcoin, and I want to make this clear. Bitcoin doesn't need the institutions to survive, right? But it's going to be a lot of money that comes into this space really quickly, and you guys have been able to get there first. The second thing is this FASB ruling, and this is complicated. I'm not going to get into this here. Michael Saylor, he's done an incredible job explaining this, and this is one of the things that has been a pain point for the companies who own Bitcoin, especially for Michael. But essentially, the old ruling made companies treat Bitcoin as an impaired asset if it went down. It hurt your balance sheet. It was very painful, but this has changed. So now companies can own Bitcoin, right? MicroStrategy at the end of January held 190,000 Bitcoin. I know he's bought a few more this last few weeks, but his purchase price was $5.9 billion. That Bitcoin today is worth over $11 billion. Well done, Michael. Wow. Apple has $60 billion on their balance sheet. That's in cash. They're sitting on that melting ice cube. I know they think they're smart. They're very smart because